On December 31st, 2025, the Indian financial community, it really lost a titan. Siddhartha Bhaiya, a man that many called a maverick, a guru, even the undisputed multi-bagger king, passed away unexpectedly. And his story, it's so much more than just making money. It's a masterclass in intellectual honesty, in having contrarian conviction, and, just a deep, fundamental understanding of how markets really work. So today, we're going to deconstruct the framework of this quantitative virtuoso and see if we can uncover the principles that drove his just extraordinary success. So let's just start with the number that really defines the legend, 32.87%. That's the compounded annual growth rate of his flagship fund since it started back in 2013. Now, for anyone who's in the markets, a figure like this, held for over a decade, it's almost mythical. It tells you this wasn't just a lucky streak, it was a robust, repeatable process. Now, to really put that into perspective, the Nifty 50 Total Return Index, it delivered about 13.5% over that same period. The gap between those two numbers, that shows you the sheer scale of the alpha Bhaiya was generating. He wasn't just riding the market's wave. In fact, with a beta of just 0.15, his returns were almost entirely his own doing, driven purely by his unique ability to pick stocks. So who was the man behind these incredible numbers? Well, Siddhartha Bhaiya started out at Nippon India Mutual Fund, and he actually became one of its youngest fund managers. But he had a bigger vision. In 2012, he founded Equitas Investment Consultancy with just 10 crore. By the time he passed, he'd built it into a 7,700 crore powerhouse. And this was a firm built not on slick marketing, but purely, and I mean purely, on performance. Bhaiya always said that at his core, he was a bean counter. And he meant it. As a chartered accountant by training, his superpower was this almost forensic approach to balance sheets. He didn't see businesses as stock tickers, he saw them as living, breathing financial statements. And that gave him a massive edge in understanding the true quality of earnings and spotting red flags in small caps way before they ever hit the institutional radar. And that whole bean counter mindset, well, that was the bedrock of his entire philosophy. His genius wasn't about choosing value or growth. No, it was this disciplined synthesis of three pillars he called QGV: quality, growth, and valuation. He was convinced that the biggest alpha is found right where those three things intersect. This framework was the engine behind every single investment decision he made. Okay, so first up, quality. For him, this was the non-negotiable risk filter. He would only even look at companies that were in the top 500 by profit after tax. Now, this is so critical. It was based on proven profitability, not market cap. So that immediately kicked out all the speculative penny stocks and loss-making ventures, forcing him to focus on real, established businesses that were often just undiscovered. Second, growth. Of course, he wanted companies with the potential to grow. He targeted a 30% CAGR over a 3 to 5 year period. But, and this is a huge but, he was obsessively disciplined about the price he paid. He completely rejected that whole growth at any price story because he knew that overpaying for future growth is one of the quickest ways to absolutely destroy your capital. And finally, valuation. For him, this was basically just another word for contrarianism. He would actively hunt in sectors that everybody else hated, that the consensus had written off. He was looking for a massive margin of safety, where his downside was protected by hard assets or just cash on the balance sheet. He famously said that once a stock becomes a secular growth story, it's probably time to get out. This contrarian mindset was actually systemized into what I think is his most brilliant contribution: a 5-stage playbook for sectoral cycles. It was this practical, repeatable framework for systematically figuring out when to get in and when to get out of industries that the rest of the market had just left for dead. Just think about the discipline this framework requires. It's immense. Bhaiya's whole strategy was to invest heavily in stage 1, despondence, right when a sector is at peak pessimism, when everyone is running for the hills. He wanted to be fully invested by stage 2, hope, just as the financials start to turn. Then he'd ride the wave through growth and exuberance before his sell discipline kicked in and forced a complete exit by stage 5, right when you start hearing, this time is different. And the results of this playbook? Well, they're now the stuff of legend on Dalal Street. I mean, a 100 to 120 times return in Avanti feeds, 50 times your money in Sangvi movers. These were high-conviction, concentrated bets in companies nobody was looking at, all identified using his QGV and five-stage frameworks. This is the tangible proof of his philosophy in action. But his entire philosophy, everything he believed in, really culminated in what might be his single most defining call. In late 2024, the small cap index was at euphoric highs, and Bhaiya took a stand that, frankly, required immense psychological fortitude. He put himself completely at odds with the entire market, and he didn't just talk about it. He acted. First, he publicly called the top, warning of a bubble when PE multiples just made no sense to him. Then, by April of 2025, he moved nearly 90% of his portfolio to cash, flat out refusing to participate in the frenzy. By the end of the year, he had pivoted the majority of his assets into gold ETFs. It was a masterclass in preserving capital and a total rejection of career risk. He chose to be right over being popular. So the final lesson from the Maverick of Dalal Street is this legacy built on three pillars: the precision of an accountant, the vision of an entrepreneur, and the courage of a true contrarian. What he proved, I think, is that intellectual independence is the single most valuable asset any investor can ever possess. You know, maybe his entire philosophy can be boiled down into this one powerful quote. He understood that a bull market can make anyone look like a genius, but true skill, that's measured by your ability to protect capital, to endure the cycles, and to prioritize the long-term survival of the portfolio above absolutely everything else. That was his guiding principle. And all of this leaves us with a final question. In a world of constant noise, social media chatter, and that nagging fear of missing out, Siddhartha Bhaiya's legacy really challenges us to ask ourselves, what does it truly take to develop our own conviction, to trust our own research, and to find the courage to stand alone?